My name is Aidan Holloway. I'm the UK Head of Financial Services at Edelman Smithfield. And we've got a great lineup of fixed income experts today for your edification. We have April LaRusse, Head of Investment Specialists at Insight Investment. We have Tom Ross, Head of High Yield at Janus Henderson. We have Marcelo Assalin, Head of Emerging Markets Debt at William Blair Investment Management. And we have Joe Little, Global Chief Strategist at HSBC Asset Management. So to our first question, I think the question is how worried should we be about rising global debt? That might sound like a leading question. And as a natural worrier, I'm keen to hear about this thorny issue. People may have read quite a bit about this. According to the Institute of International Finance, global debt hit a record $307 trillion in the second quarter of the year, despite rising interest rates curbing bank credit, with markets such as the US and Japan driving the rise. Global debt has risen by $100 trillion over the past decade. With that not at all leading set of stats, how worried should we be about rising debt? April, would you like to kick things off?
Oh, you want me to be worried, don't you? Well, it's hard not to look at the graphs and some of the stats on how much of the government revenue is going just to service the debt and not think, could this all go horribly wrong? Lots of examples in history of countries getting over-levered and then finding themselves in a rather difficult situation, even if it's just like a sort of protracted period of low growth, like Japan, for example. Yeah, it is worrying, but, rationally, you have to think to yourself, well, when interest rates were as low as they were for as long as they were, that naturally creates a certain incentive, a certain behavior, right? So if it costs nothing to borrow, well, it'd be kind of rude not to. And countries behave like companies. So in the same way, they were saying, debt service costs are nothing with interest rates so low, so I'll just continue to issue. Obviously, the way that politics is moving with this more, shall we say, populist approach, they need to spend money to keep people happy. So again, more borrowing, just in terms of how the sort of political pendulum is swinging back and forth. Is it a worry? Well, so far, there aren't a bunch of failed auctions. We're not seeing, massive dislocations in markets. So not yet. But we would, I think, and the focus on the UK budget was probably something that a lot of you were reading about and thinking about, shows you that, even the sturdiest, most hardy countries, people are focused on, is there any desire to get a hold of spending? Has anyone got the guts to do it? And so far the answer is no.
Yeah, no austerity here in the UK. We've been told that many times. Tom, your take on the global debt mountain?
Well, I thought I'd throw some more fuel on the fire to start
Please
with.
Please
do. Because you've only mentioned about government debt, but we're now facing an enormous rise in investment grade debt next year because of all of the hyperscaler capex supply that's coming as well. So this has been talked about lots recently. Just to give you the figures, so estimated 500 billion of capex from the big five next year, maybe 700 billion or more next year. And again, this is like a 3 to 5 year plan potentially, depending on how optimistic or bubble fearing you are about AI. We're probably more towards that optimistic end. I mean, a lot of that capex we believe will come through. And again, there will be a lot of supply within that market. So next year, I think, if you're talking the more bearish consensus line, 100 billion of extra supply, but you can easily talk 400, 500, 600 billion of supply in investment grade next year. And that compares to what there's been 1.6 trillion of treasury issuance. So this is not insignificant in terms of what we're talking about in these terms. We're probably on the more benign side from this, because when you look back at other periods where sectors have issued lots and lots of debt, shale in the US before the dot-com crisis, banks as well with TLAC when they had to issue more debt there as well. But generally, we do think this is probably more like the bank TLAC supply as opposed to shale or anything else. I mean, these companies actually, the big five, could actually spend their capex out of earnings. They're doing it through debt because it's cheaper to do so and it makes more economic sense. but it's not like they don't have the earnings to be able to support that. But equally, that is a chunk of investor demand that is going to go away from government debt that also needs investor demand to keep it sustained.
The glut of supply could be a challenge next year. Marcelo, what's your take on it from an emerging markets perspective?
So as the emerging market, that guy here will try to put out some of this fire. Right? I've been through many debt crises in so many different places over my 30-year career. So the numbers look quite shocking, right, that you quoted. We also need to consider that the global GDP has grown over time as well. Yes. Perhaps as a percentage of the global GDP is not that bad. Doesn't make it good, right? But it's certainly not as shocking, right? I'm not in the camp of those who believe that we're going to see a debt crisis in advanced economies anytime soon. We cannot underestimate the ability of governments to hike taxes and print money, right? And confronted by pressures from the bond market, as they have, this is a story familiar to all of you, right? We're going to see more tax increases. And in my opinion, yes, bond investors should be cautious. But taxpayers should be worried, right? Because that's going to be their way out. Yes. and why that is even worse than a debt crisis, in my opinion, because that impacts growth potential, right? Investments, productivity, and that's the bad news right now, right? Is lack of growth, and that's why we're concerned about that, because there's no growth in developed economies. But let me stop here, Joe.
So I think the conventional way that people often frame this is debt to GDP or some such metric. That's not really the right way to look at it. April is spot on. Interest expense is a better way of framing the problem. It's a flow and a flow rather than a stock and a flow concept, or debt versus global wealth. So I focus very much on that interest expense concept, and that's really relevant in terms of the affordability or the sustainability of the problem. And like was mentioned, in a low interest rate environment, it's straightforward. But if, like me, you worry a lot about the global economy now being shaped by supply shocks more than just by demand shocks, that's the Rubicon that we have crossed, and we've entered a sticky inflation, spiky inflation, higher interest rate environment, then there's a challenge around interest expense. The other variable that's really worth monitoring is the sort of what economists call the golden law, which is how interest rates are set versus growth. And if you're in a situation where nominal growth is above nominal interest rates, then it's all straightforward, frankly. If it's the adverse situation, then you're Italy and you've got a problem. And that's really what I think the principal concern to me would be. Japan has been the classic example of why economists have got everything wrong about debts for the last 30 years. But that idea and framing of the problem only works when you're in that low interest rate equilibrium. When the JGB yield is flirting with 2%, then suddenly some of the arithmetic is reconsidered. So I think it's a very relevant question. I'm not sure that it's anything more than a really big sensationalism, but it is going to have a big bearing on global markets in terms of the kind of cadence, the shape of the yield curve, the volatility, and this interface with what the politicians are going to be trying to do as well, the sort of bond market vigilantes returning. So definitely a really key question, but not in the very pessimistic doom camp either.
Okay, great. Sensationalism from a PR agency. Who would have thought it? Thank you, everyone, for that. So, talking of sensationalism, our recent Investor Pulse research found that nearly all investors, and I think Marcelo is obviously in the minority here, 97% of those polled see a sovereign debt crisis in a developed market as a likely scenario in the next 3 years. And that's defined as a disorderly sell-off, a major spike in yields, and forced policy intervention to calm markets. 63% of investors think this is very likely, 34% think this is fairly likely. What are the panel's thoughts on this? Do you concur that a sovereign debt crisis is all but inevitable?
Goodness. Okay, I'm going to start.
Okay.
It's possible, which is a really boring, woolly answer. But the more important question is, do they have the tools to put out the fire, even if it's kind of by cheating? So I would put in the cheating camp, restarting government bond purchases in earnest. So, you know, they've got this lovely toy they can use, just buy bonds and suppress yields. They could, of course, change regulation in ways which would either force or encourage higher levels of government bond investment by entities that get a tax benefit from just being who they are. I mean, a pension fund obviously gets a beneficial status. But if you really want to maintain the beneficial tax status, you have to have higher levels of government bond investing, for example, as a way of creating a kind of increased demand. You could tell your banks, you need to have more government bonds on your balance sheet for certain levels of solvency. It's not, none of this is popular or nice, but it is ways to force or encourage more investing in government bonds, which in theory should calm things down. And I feel like I'm going to stray into Marcelo's wheelhouse here, but I think there was an article out on Bloomberg today about the Colombian government contemplating higher levels of government, local Colombian government bond investment by pension schemes. You know, so forcing, encouraging, basically finding increased demand for your own, to fund your own government.
Yeah, so might see some mandation or market intervention of some description.
Yeah, they have the ways they can make us buy them.
Joe, can I come to you next on that?
Yeah, so I agree that you can find some techniques. Financial repression is sometimes referred to as you just cap the yields. The Bank of Japan's already revealed that playbook to everybody. The problem with that maybe is that it pushes the problem somewhere else. So your title is no longer bonds panel, but it's FX panel.
We can be both. We're flexible.
And that would be my worry in that situation. Look, I think this is a really important variable which is going to be increasingly relevant across global markets in 2026 and beyond. We're learning a lot from emerging markets. Developed markets have become emerging. Well, emerging market bonds are lower volatility than developed market bonds now, even including the currency. So I think it is such a relevant issue. But I come back to this idea that the mechanism is as much about global policing as anything else. So if you have a situation where global governments, particularly in the West, want to pursue a strategy of active fiscal policy to support the populist agenda, which has already been discussed by the others, and that is attempted to be done by unfunded spending promises or more expansionary fiscal policy by hook or by crook, then the bond market is going to have an opinion on this. And the steepening of the yield curve, which is something we've seen all year, the volatility in particular at the ultra-long end of the yield curve, that 30-year volatility, may be more constrained to Japan, France, and the UK, but we've seen flavors of it in the US as well because the term premium has been rising significantly. That is the mechanism which imposes fiscal responsibility or some kind of balancing and monitoring of behavior. So I think it's probably wrong-headed to worry too much about a crisis in the sense that it just inspires and encourages bond market vigilantism to then police and check the behavior of governments. I mean, having said that, the dynamics that we see in the Treasury market and other markets this year is so important for global investors. Central banks are cutting rates, but bond yields are either sticky or moving higher at the ultra-long end. So I call it the reverse conundrum. It's sort of the opposite of what Bernanke and Greenspan faced when they were even hiking rates, but whatever they did, bond yields were ultra-low. We have this dynamic of a reverse conundrum, and it is very similar to what we've seen from time to time in emerging markets. Fiscal dominance has come to bond markets. So it's such a key theme, but no crisis for me.
Okay. Marcelo, what's your, I mean, we've talked about Colombia and Joe just mentioned emerging markets. What's your take on the sovereign? I mean, you don't think one's going to happen, but what's your take on it from EM?
One thing's clear for me, there is a big disconnect between the outcome of the survey and how bonds are priced in the marketplace, right? I hear you, that Joe, that curves are getting a bit steeper. I think the fiscal related risk premium is still not properly priced, right, there. But I don't see a situation where, things will get out of control, right? Because governments will be coming up with creative solutions to anchor the bond market, right? Which is not necessarily positive, right? Going back to the, in EM it was very common to see private pension plans being privatized, nationalized, for example, so governments could rely on that pool of capital, right? But going back, what is happening, I think, in the US, why the curve is steeping, is not related to fiscal concerns mostly. It's more related to an economy that is growing between 2 and 2.5% with inflation at 2.5, 3%, right? Where should rates be? Especially considering that the Fed may become more dovish under the new leadership. So the curve will naturally steepen, right? Is it because investors are getting concerned that the US government will not pay back, or fiscal risks have increased materially? I don't think so. I think it's more still a function of growth, inflation dynamics, and expectation for monetary policy.
Tom, anything to add to that?
No, in fact, no, you've sort of articulated that very well. I'd sort of say it almost feels like inflation is public enemy number one, because that's what's then going to cause the issue. So I think we might be talking about later, but the K-shaped economy, and how our view is that, yes, we've got all of this growth from AI, which actually we don't think is particularly inflationary. It's sort of more important what happens with now the rest of the economy, everything else that doesn't have the benefit from AI. And as you say, with a slightly more dovish chair coming into the Fed, etc. We're still talking about cuts for next year, but eventually we almost need to go through like a pro-growth phase, pro-growth everything else phase, to then start worry about inflation. That's when we should get worried about it. So again, I think 3 years is a nice convenient time to be able to say, yeah, probably something could happen over that time. But again, there's no real evidence yet. We can see maybe the pathway that might happen, but there's so much to happen, I think, before we get there. And again, it's the cure for inflation, which is the problem. So again, that's further down the line. So yeah, I think it's easy in a survey to say over 3 years we'll be worried. But again, in the short term, I think I'm with the rest of the panel and less concerned.
Good to hear. Calm nerves all around. Staying with you, Tom, if I may, and returning briefly to the survey, 91% investors expect high-yield defaults to increase over the next 12 months. You'll notice there's a theme here. Where, as a high-yield expert, what's your take on this, on high-yield defaults? Is there anything in this?
Defaults are always rising, aren't they? It's look, from low levels. I think again, it's a concern that we always have. It's a concern. It's not just for high-yield investors. It's for all investors. So what have we seen so far? Well, they've sort of gone up a little bit recently, but normally defaults are caused by an economic shock. Yeah. And so you have worries about the shock, and then 6 months later you then get a spike in defaults caused by the economic shock. What have we had recently? Well, the slight rise we've had in defaults recently wasn't caused by an economic shock, it was caused by an increase in rates. So what happened in 2022 has now caused SFR and all of the big mature businesses, etc., to then start to go through their LME now, or in the recently, or in the upcoming months, etc. So again, like default rates, I often think are probably what we shouldn't be looking at, because we care about, SFR bonds have rallied 20% in the last year and a half, even though, they've only just done their LME recently. So it's more about when the losses are felt. And typically, again, unless we think there's a big rate shock coming, potentially, and that would obviously cause issues, but I would say it's if there's a growth shock, that's what would then cause it. I don't think there are going to be any more. My default rate hasn't changed pre or post what happened with first brands. That's not a systematic issue. It's one company that fraudulently took on too much debt and hid it in loads of different places, etc. But again, we should have been worried about that before we found out about it, as we are afterwards. If there's a shock to growth, and especially, this bit and this bit, then that's when defaults will rise. But we're actually relatively optimistic on both of these, which then does lead through to the inflation issue further down the line, this issue further down the line. But then in the shorter term, we'd actually see, yes, there will continue to be idiosyncratic little bits of defaults here, but we don't see a significant rise in the short term.
Great, thanks. Joe, do you have a view on that?
Well, I like this idea of the K-shaped story very much, and it has been popular among economists and my colleagues, my peers, all year. And I would think about the different scenarios for 2026 or even multi-year time frame as playing around with the shape of that K. So the central scenario that I would have in mind would be that the legs of the K.
Yeah,
The legs of the K.
I suppose so. Yeah.
Arms. Maybe arms is better. The arms of the K.
The limbs of the K.
The limbs of the K. Okay, yes, that would maybe be better still. But that they come together a little bit more. So that's some challenge to the lopsided nature of growth. AI contributing virtually all of the growth in the US that we've seen in the first half of the year. Still contributing, big investment boom, adding maybe 0.5 percentage point to US growth next year, but a growth acceleration coming from policy impulse. The Fed is cutting, fiscal policy is going to be less tariff uncertain next year, maybe checks being compensating in the post if there is a reimbursing from some of the tariffs. We don't know. But that means that the policy impulse is then positive, which can foster a spillover of growth into other sectors and maybe some catching up, the so-called broadening out trend in the stock market. Now, if that's what happens, then you're not worried about defaults, because defaults are about liquidity and they're about profits. And if if nominal activity is picking up, and if the Fed is cutting a little bit, and maybe the new Fed chair is worth one more cut, maybe, then the backdrop should be okay. The thing that worries me is the consequences of a pickup, a cyclical pickup in growth, and this positive policy impulse on the inflation pattern. So we suspect that the world has changed to one more of supply constraints and supply shocks. That means that your run rate of growth before you start hitting inflation challenges is not quite as much as where we've become accustomed to. So I think economists, analysts, investment strategists are maybe a little bit too relaxed about cyclical inflation in 2026. That could be a challenge for high yield markets. I think there's also a challenge around pricing. So our credit fund managers, credit investment team are most concerned that the market is just priced for perfection. And that doesn't leave you much wriggle room if there is any sort of disappointing news, idiosyncratic or something a bit bigger. It can create these bouts, episodic bouts of volatility. So they would be the two things that I would watch. And our house view is then to focus on quality in the credit structure. So investment grade, I guess, is the obvious thing to emphasize. Securitized credit, but also then direct lending in the private credit space. That would be the sort of quality options that investors have.
Thanks, Joe. April, anything to add in the high yield space?
I think when you've had, going back to the sort of historic low levels of interest rates, and business models worked very well. I mean, you could run practically any business with financing costing you nothing. And then
Some still struggled though.
yeah, some still struggle, incredibly. But interest rates, they're going to come down, but they're still pretty high. So there will be some business models which just don't make sense with the levels of debt that they have, with interest rates where they are. So although we're not very worried about the high yield default cycle, we could definitely see there's a few businesses which might not make it. Obviously, Altice SFR is one of them. But we're thinking about things like quite a lot of amend and extends. I can't pay this. Let's give you a new bond with slightly different terms with a longer maturity date. Oh, I can't pay my interest. Can I roll it up and pay you at the end? Payment in kind type structures. Those tend to happen when there is a little bit of sort of, shall we say, corporate distress. Not a lot, because the economies are really quite good. And we were just looking at some of the economic data going, gosh, you'd think from reading the press that things were a complete disaster. But actually, if you believe the GDP numbers or the PMI numbers, things are okay. So, that's what high yield businesses companies need. They need growth, any kind of growth. So in order to be able to continue to exist. So there will be some who don't make it, so probably a slightly higher high yield default rate, but nothing catastrophic, nothing kind of global financial crisis type.
We'll add one point to that. I think the reason that companies have been able to see through this as opposed to the economic shock, like companies with time can shift their business. Some can't. but many of them are actually pretty good at managing. Once they have enough time to be able to then tweak little bits here or there, cut, etc., they can see through that. And this is sort of it's just like a slow-moving issue, as opposed to economic shock, or obviously COVID shock is then the worst case scenario, because they just can't deal with that. Like, they can't adjust in that short space of time. Some still don't make it through, but I think that's why, again, you'd have thought there would have been more issues, but they've been able to adjust amazingly well.
Brilliant. Thank you very much. I'm conscious of time. I'm keen to ask this question, but Marcelo, feel free to chip in on that point while I ask another one, though, if that's okay. There has been quite a lot of uncertainty around the global economic picture. I think things are okay. I think the UK economy would probably take that outlook. The consensus on economic outlook, though, is very different across different countries, and it has swung back and forth over the last 12 months. I'm not only thinking of the likes of US and UK, but also European economies like France and emerging market economies like Argentina. Starting with you, Marcelo, if that's okay, what's your outlook on the direction of travel for rates and major currencies in 2026 against this kind of slightly volatile backdrop?
Sure, but before that, I would like to touch upon the default outlook, because I cannot remember having such a benign outlook for EM credit as we have today, right?
Heard it here first.
Resilient growth in EM, stable fiscal dynamics, stable debt levels, right? Very strong capital flows, right? Very positive combination of factors. Long story short, if you look at our sovereign universe, there are around 70 plus countries there. Right now, we only think that there are 2 countries there that can face issues, like Bolivia and Senegal, and they are less than 0.5% of the index in weight terms, right? And we don't even think they will restructure a default, right? So basically, our outlook for credit default in EM sovereign credit today is 0 for the next 2 years, right? In EM corporate credit high yield, we believe is going to be between 1.5% and 2%, which is lower than in developed market credit, right? So this is a very, well, as I said, I can remember seeing such a positive combination of factors, right? But going forward, our outlook for EM is still decent growth, right? Close to potential, if not a little bit above potential. Inflation will continue declining, unlike in many advanced economies. Central banks will continue easing. Actually, central banks continue to ease even when the Fed was on hold, right? And currencies are still overvalued in most places, right? I see a combination of factors that will lead to lower local rates and stronger currencies, right? In spite of the very strong performance we've seen so far this year. And I think the bright spot next year will be in the frontier markets universe within emerging markets debt.
Brilliant. Frontier markets is the place to look at in 2026. Brilliant. Thank you. Joe?
So which question are we answering?
We are looking at the outlook on the direction of travel for for rates and major currencies next year.
Okay, I'm just pulling your leg.
We didn't rehearse that.
Yeah, I mean, the scenario for me is modest cuts from global central banks in 2026. I think the cyclical inflation, or the risk of cyclical inflation, could put a little bit of a spanner in the works. Not necessarily sure that it changes the end point. We have the Fed at 3.5% by the end of the year, end of next year, I should say. I'm not necessarily sure it changes the end point, but it might make the journey a little bit more interesting and volatile, particularly if some of the influential Fed speakers start worrying about inflation data publicly. So I think that's interesting to watch. It is a tricky, complex situation. There is a lot of uncertainty. I'd add to the point that Marcelo made on emerging markets, because we have seen significant leadership from the emerging markets, starting with Mexico, but all across the whole complex, cutting rates ahead of the Fed. They've been the leaders this cycle. They've had much better inflation control. That's why emerging market bonds are much lower volatility now than developed market bonds, even including the currency. But I suspect that what happens in 2026 is that everybody's waiting for the Fed. And we've seen already a slight different tone from some of the major emerging market central banks about how much easing they want to do. In Asia, the big focus is on fiscal policy now rather than on rate cuts. But nonetheless, higgledy-piggledy weaker dollar would be my scenario for 2026. And I think it all supports emerging markets as the sort of top pick. So local currency emerging market bonds would be the sort of area I would tend to focus on. We see the currencies as being undervalued. We see good opportunity for pickup in terms of returns, modest rate cuts. But the stunning realization for me is this idea that the emerging markets have not just been lucky, they've also been good. They've improved the macro position, they've deepened the financial markets around local currency bonds, much bigger ownership locally rather than just the foreigners owning the bonds. And that robustifies, creates resilience in the asset class in a way that we just haven't seen before. So I think that's the sort of top pick for the year in an environment where we think the dollar's going to be modestly weaker and the Fed's going to be cutting a little bit.
So a lot of positivity around emerging markets. And
yeah, it's our top pick.
Yeah, excellent. April.
Ooh.
Rates and major currencies.
Okay, thank you. I'm going to be a bit cynical.
Oh, please do.
If you have a whole pile of debt and you want to keep issuing lots of bonds to do all your wonderful things to make people happy, it makes sense to try and lower interest rates to make your debt cheaper. I think in the UK something like 8% of government revenue is being tied up just servicing debt costs. So having a lower interest rate is obviously helpful. Also, of course, all the central banks and issuing entities are skewing issuance towards shorter dated bonds because, the longer ones are rather more expensive and they see more demand for the shorter ones. So whether it's a good thing or not, interest rates will come down. And they will clearly in the US be incentivized to do so by an angry president. So, and I think if you can find a way to justify lower interest rates and doing it quite quickly, then you are going to do it because you want to get your debt costs down. And in the US, obviously the labor market is providing the reason for cutting interest rates a lot, fully in the price now. And the UK is obviously hoping that the CPI numbers will cooperate, allowing the Bank of England to get rates down, and Europe's already there. The only country going the other way is Japan.
Right, rate cuts in 2026. Tom, conscious of time, if you can be succinct, please, and then I have a very quick-fire final question.
Okay, well, I don't have anything actually to add.
Okay,
other than
brilliant. Okay.
everyone else, given I think we've covered that one, so I'm happy to take
Perfect, thank you so much, that's lovely. A quick-fire final question then. Please, can you all give me one overweight and one underweight pick in the fixed income space? And Tom, I think it'd only be right that I go to you first.
So as you say, we think spreads will stay relatively benign, etc., but with risks out there that we don't know if they'll materialise. It's about making your portfolios work harder for you. So at the moment, it's overweight securitised. It's getting that extra spread for lower volatility. In terms of PANs, it continues to be the long end of the curve. So it's front end and securitised, and leave the long end alone.
Marcelo?
So I mentioned frontier, local markets. I think there's significant scope for performance there. Individual countries, my home country of Brazil, local bonds, right? Very high yields. The central bank will continue. We will cut interest rates. The currency, in my opinion, is still undervalued. So I think it has strong potential.
I'll take India.
Okay.
India, government bonds, local currency. India. I mean, India's had a tough 2025, so a role reversal in 2026.
Okay. April.
Australian bonds look really cheap now.
Okay.
They've taken out, basically the market's starting to price in hikes there because they've had some stronger data. That just looks well overdone. So Australia looks interesting. In contrast, U.S. Treasuries look really expensive. They priced in rate cut, and if there's any kind of concern over any of the inflation numbers or about how the Federal Reserve might change how it behaves, there is scope for a sell-off there.
Any particular point in the curve?
Well, tens, probably.
Brilliant, thank you very much. We've got time, I think, for a few questions. So, yes. Got one there.
Thanks, Douglas McNeil again. Marcelo mentioned that governments always have the tool of tax increases at their disposal to deal with rising debt. Is that something we should expect more of in developed markets going forward? Should we assume that public debt ratios will continue to creep up and that tax ratios will creep up along with them, so that over, I don't know, a 5-year period or something, debt burdens will creep up by, say, a percentage point or two? Is that a useful way to look at it?
Who would like to take that?
I think, personally, I think if you're in a populist time, they will try and do other things besides continue to just put up taxes. So, I mean, obviously, they've done a lot of that, well, particularly in this lovely country. But there will come a point at which they have to do something else.
Any other thoughts, panel? I've just been told, actually, we've run on by 2 minutes, so sorry about that. Any other thoughts before we wrap up? Unless anyone has a question that could be answered in sort of 10 seconds. No, it just remains for me to thank my panelists. Thank you so much for a fascinating discussion.